What's up, everyone? Welcome back to another episode of the eCommerce Influence Podcast. My name is Austin Brawner, and I have an excellent episode for you today. My guest today is Karen Howland. Karen is the managing director at Circle Up. Circle Up is an investment platform that uses technology to invest in early stage businesses, mostly CPG. And during this conversation, we go deep into early stage investing. And we talk a lot about what entrepreneurs need to know about raising money, what opportunities are out there right now, particularly in the CPG space, what she's excited about. We talk about the relationship between Amazon, direct-to-consumer, retail. She shares a lot of what she's learned from working with companies like Halo Top, Liquid IV, and honestly, Circle Up has invested in so many of the sexy CPG companies that you might have heard of, that she's got a lot of great insight, and it comes from a different perspective, the perspective of the investor. I think you get a lot out of this episode. If you are an owner, operator of a business in the e-commerce space, you're going to get a lot out of it. So I really enjoyed it. I hope you guys enjoyed it as well. Let's bring Karen into the show. Karen, welcome to the show.
Thanks so much for having me.
I'm really excited to have you here. I'm excited to talk with you. I have kind of from the outside seen Circle Up and what you guys have been doing and investing in different CPG companies. And before we hopped on, I was like, I think you guys have invested in most of the cool up and coming CPG companies that I know. If I see I'll always find some cool health food and I'll be like, this is a really cool product. And then I looked on your website and you guys were involved with most of them. So it's exciting to chat with you and to learn a little bit more about what you guys are doing. But I would like to start and learn a little bit more about how did you get involved with Circle Up and how did you first get excited about getting involved with investing?
Yeah, it's a great question. I joined Circle Up about 3 years ago. I actually have spent about, call it 15 years in the consumer investing space, but spent a lot of time on the public markets. I'd had a chance to do some early stage consulting for some early stage consumer consulting projects. And I had this aha moment of I have all of a sudden added what I believed was so much more value in a really, really short period of time than I had, call it for the 15 years before, trying to invest in the public markets. And I love my job in the public markets, but just the value that I felt like I was creating, the personal wealth I was gaining from doing it just got me so excited. And I realized I had to do a transition from public markets to the private markets. I happen to have a data-driven background. I had worked at several large institutions, most recently Citadel, which is a very data-driven hedge fund. And I got really intrigued about the prospect of using data in a more systematic way when thinking about the private markets. I happened to get introduced by coincidence to Circle Up, who was looking for someone to come on for this role. I knew I had this passion for early stage investing. I knew I had a passion for data and data-driven insights. And it was just a great marriage, and I just jumped at it.
Cool. Well, for those of you who don't really know what Circle Up does, what is the mission of Circle Up, and what makes you guys different from other funds that are out there?
Yeah, our mission is to help entrepreneurs thrive by giving them the capital and the resources that they need. The capital piece, I think, is somewhat generic, right? That's kind of what funds do, is we provide capital to other institutions. I think it's the resources that we're really different in. So we have been developing a database called Helio over the last 8 years, which goes out and tracks 1 million different consumer brands, and it tracks them from everything from price positioning to ingredient profile, social media engagement, door growth, and tries to predict which companies are going to be the quickest growing businesses going forward. So we use that very often when we actually reach out to companies to try to streamline what companies we want to talk to. But then it also helps us evaluate the companies. And most importantly, it helps us work with the entrepreneurs afterwards as they're trying to develop strategic initiatives to help build their business going forward. So a perfect example is one of the companies that I work with we're going to pitch to a retailer. And they asked, how do we prove that we're able to provide a larger basket size than their competitors are. We were able to use data to help inform that decision, to help give them insights that they could then go to the retailer and say, our basket size is 25% higher than competitor X, Y, and Z. That's just one example, thinking about different retailers to partner with, thinking about the competitive set. We're able to use data to help inform those decisions. So I think that aspect is really one of our key differentiators. The other thing I would say is we've been helping early stage consumer brands raise capital for the last 8 years. We've iterated our model a couple of times, but at the end of the day, we've helped over 300 to 400 entrepreneurs raise capital at this point. Because of that, we have a really amazing network of early stage founders that we can tap into, that when a company is having issues with UNFI charging ridiculous pricing, or when they are having an issue with figuring out who the right broker is to go into Costco, I don't know that I necessarily have the answer to that, but I know I have a network of 300 entrepreneurs that I can send a quick email to and get some really interesting insights really quickly.
Sure.
So I think that network and the data platform are really the two key differentiators that we bring.
So 8 years, you guys have been doing it for 8 years in mostly CPG, right? Or early stage CPG, and a lot of health products. What has changed over the last 8 years? What have you seen that is, I mean, this has been, I know you've been there for, I think it's been 3 years, but since the beginning of Circle Up, 8 years has been, I think it's a long time in the health space as things move and change and grow. Like, what are some of the trends that you've seen come and go, and what's hot right now?
I could talk about plant-based. I could talk about adaptogens, nootropics, all three of which are right now accelerating in a meaningful way. Brain health is something that we have been doing a lot of work on. We're seeing a lot of really interesting innovation there. But I could also go to the other end of the spectrum and talk about, cleaner ethnic food, right? Which is a little bit more basic and not quite so like edgy and exciting perhaps to talk about, but we're seeing a ton of innovation on that front. I think to me, what's really changed is the ease of starting a business in the consumer space.
Sure.
Right? Because the ability to launch a brand, put up a website, put up have a Shopify system on your website and be able to transact, use Amazon, be able to transact there. It's taking a huge barrier, which is like actually having to get your product on the shelf of a Walmart or on the shelf of a Safeway. It's taking that out entirely. So the ability to actually launch a brand and introduce that to the consumer is as easy as it's ever been. On the flip side of that, the competition is getting as hard as it's ever been, right? Yeah. Because there are all of these early stage consumer brands getting launched. You really need to focus in on how is this different in a way that matters to the consumer, right? Like, is it the best non-GMO, vegan, plant-based, smaller consumer set that you're targeting? Or can it in fact matter in a really big way? I would say, I was talking about more competition from the consumer space. It's also getting more expensive to launch these brands because of the competition to get the eyeballs from the consumer. We saw pre-COVID customer acquisition costs online beginning to rise in a material way as people were moving more D2C, but it really wasn't the large incumbents that were pushing that. It was much more these early upstart businesses. COVID hit, customer acquisition costs fell really quickly, actually, because I think everyone just sort of freaked out and wasn't sure what was going on. But we really accelerated the shopping habits online multiple years in advance, right? Like we accelerated in such a huge way this past year. I think it was a really eye-opening experience, not only for these early stage brands that we work with, but also with a lot of the larger incumbents of, okay, I need to really hone in on my skills. I need to be nimble. I need to be advertising. I need to be getting those eyeballs. And because of that, the competition, as far as being able to actually access those eyeballs, is increasing in a material way.
It was incredibly interesting watching that, working with clients directly through that time, and feeling like different levels of apprehension that happened back in March during COVID. And then as there was levels of apprehension that happened as so many things changed. There was like social unrest across the country. And at the same time, I had clients who were having record months because their customer acquisition cost like literally cut in half, and they were spending money. It was really wild. It's kind of come back at this point after over a year. It's interesting to see like where we're at right now and how there definitely is more competition now and more people that were, I think, enticed in by these low acquisition costs, and some of the big players you're talking about are back in it and maybe accelerated going forward. When we look at like CPG companies, and it's interesting because I had a conversation with with a friend a couple of years ago, and we were talking about beverages, and she was quite disappointed at a company that had, quote, sold out because they were bought by Coca-Cola. And I was talking to her and I was like, okay, like what are the options besides selling out to Coca-Cola? Right? It's very, very, especially in like the beverage space, in CPG, a lot of times it'll be a path to an exit with a large company that acquires a smaller company. Why is it so hard for large CPG companies to incubate and grow their own new products? And why is it not happening?
Yeah, I love that question. And this now takes me back to my public market days, right? When I used to look at the Procter and Gamble's and the Clorox's and the General Mills of the world and analyze their financial statements. It is because they are absolutely not financially incentivized to do it.
Yeah.
It is so much better to cut R&D, to make those cuts to your SG&A line, to make the cuts to your operating line. It is much more impactful to do that to your overall earnings per share and subsequently your stock price, if you assume that your stock price, like the price to value, is going to stay more or less the same. The amount of innovation you need versus cutting like $100 million off of R&D is tremendous. And so it's the first thing that gets cut every time. Things slow, things end up not going as one had hoped it would. The first thing that gets cut is those low-hanging fruit, which are always those smaller brands, which might be growing really quickly, but cost a lot more money. And it is, the companies are structurally incentivized as far as the compensation at the most senior level of management to make those decisions, to drive shareholder value through earnings per share, which tends to lead to cost cutting rather than actually incubating brands for the longer period of time. It's, in my view, short-sighted. Right? Because there's only a finite amount that you can actually cut. But it goes in waves, right? These companies will go and they will innovate and they will buy products and they will grow them. And then all of a sudden something will look a little dicey. Earnings aren't looking as good. Something happens on their international business that makes earnings not look as good. And they make the decision that, you know what, I don't need to grow. I don't need to incubate. I need to make cut costs to drive those earnings per share higher, which is what the stock market is going to reward me for.
Do you see any change ever in the future with that? Like that's I look at it from a perspective of seemingly a market that there's been a lot of CPG companies that have gone on to get acquired recently. And when I started working with eCommerce founders 7, 8 years ago, it wasn't like that, right? Like I remember the first big acquisition that I really remember was Native Deodorant getting bought by Procter and Gamble for $100 million. And I was like, okay, cool. This is like another. And then the other one was Dollar Shave Club. I remember those two were like, all right, now some acquisitions are happening in this space. Today, it's happening quite often, and it's seemingly totally different. Do you see any change in the future where these big CPG companies will actually be able to innovate and won't be looking to acquire companies, or is that something that you see basically too much momentum to be able to change?
I think history tends to repeat itself. And it feels like there's too much momentum to make it to change. That's not to say that in any cycle, so any 3 to 5 years, the companies will not talk about the fact that we are innovating, we are becoming an R&D shop, and honestly, I suspect it's going to happen now, right? Because we're right post-COVID. Everyone had record earnings because there was no toilet paper on the shelf. So everyone was able to raise the prices on toilet paper, and everyone was like, you know what, I want my Kraft mac and cheese because I want comfort food right now. And so all of these companies saw record earnings last year. Now is the time to say, you know what, we're going to put additional money, we're going to put additional resources into R&D because we've got the additional cash right now. So let's focus on that. And then 3 years from now, when things stabilize and things normalize and things slow down again, suspect we're going to be in that same cycle of reducing the R&D.
Sure.
I will say the companies that you mentioned, Dollar Shave and Native, I think are two really great examples because they got to a certain scale that it matters. And honestly, that's some of the advice that we give our founders. A lot of the founders that we work with have amazingly interesting, innovative, compelling products, and they want to change the world, right? They want to change the way the consumer eats, or they want to change the way the consumer addresses a certain personal care issue. They want to change the world. You can't get bought when you're at $30 million in revenue or $50 million in revenue if you're going to change the world, right? Because you're just going to end up being a very small piece of a really big organization. And when the time comes for cost cutting, chances are yours is going to be the one that ends up going. Or your business at least won't be in the same, it won't be given the same resources and the same emphasis that you had hoped it would.
Sure.
So I think those two that you mentioned, like they'd gotten to a good amount of critical mass before they were acquired, which is why I think they're still great brands today.
Yeah, I think they're still both growing quite quickly, seemingly.
Exactly.
Really interesting. So, but back to, you talked a little bit about like what you advise founders to do on the raising money side. For specifically talking about entrepreneur, what are some of the biggest mistakes that you see entrepreneurs making when they are raising capital?
There are a couple. First and foremost is recognizing the difference for when you need equity versus when you need debt. If you go out and you have a purchase order from Target, the last thing you want to do is come to me on the equity front and say, hey, I'd love to partner with you. Like, you've done all the hard work, right? You've got product market fit. You've got a purchase order from Target.
Yeah.
You should not be giving me, well, I obviously pay for it, right? But you should not be giving me a piece of your business to fund those purchase orders. That's the perfect time for a credit option. So I think understanding the difference as far as when the different capital structures that you could use, I think is really important. I think not having a really honest conversation with your potential investor about your time horizon ends up being problematic. To be being completely honest. So Circle Up, we tend to underwrite to 5x returns when we think about investments that we make, which it's hard to imagine a business is going to grow more than 100% a year for 5 years consistently. So we expect that we are going to be investing in businesses for 5 to 7 years. Sometimes it's less, sometimes it's more, but that's kind of how we think about it. We speak to some founders who are saying like, oh yeah, I'm planning on exiting in 2 years, but I think I can get you to the returns that you're looking for. And you're like, I'm not really sure about that. So and by the way, that could be an amazing outcome for that founder, right? Yeah. It could be an amazing outcome for that founder, for all of the earlier investors, and for another investor. It's just not the right partnership for us.
Sure.
And so really being straightforward and honest about that, I think, is really important. And this is going to sound extremely self-serving. So give me a second to explain it. But I think the other thing that we see is companies raising too much money, and hand in hand with that often is raising it too high of a valuation early. And I recognize that sounds very dicey for someone who's in the venture capital world to be saying, but if you raise a lot of capital, regardless of how genuinely you believe you are capital efficient and that you are not going to waste money, you will. If I have $20 in my pocket, I'm going to find a way to spend it. And so if my business only needed $3 million for the next 2 years, and I go and I raise 8, I'm going to go and I'm going to try a lot of really different, interesting, innovative things, right? I'm going to try new flavor profiles. I'm going to try new distribution partners. I'm going to try a different product line, things that I wouldn't necessarily have done and probably aren't going to get a good ROI versus if I had less money and I was a little bit more tight around that. And so if you're raising a large amount of money early, you typically have to do it at a high valuation or else you'll end up getting massively diluted, which inherently sounds great, right? Because you're raising at a high valuation. You own more of the business than you would have otherwise, but you have to feel really confident that you're able to grow into that valuation. And I can't tell you, unfortunately, the number of times, like everybody believes they're going to grow into that valuation.
Oh, for sure.
More often than not, people don't. And then when you have to do the next round, no one wants to invest in a down round. The investor doesn't want it. The founder doesn't want it. The other investors don't want it. And there's a stigma that comes with it that's challenging to get over. So those are the handful of things that we've seen.
Yeah, it's interesting. I had Moiz Ali, from the founder of Dative, on the podcast a couple of months ago, and he was bringing up the same thing. He was bringing up just the fact that he had a very open conversation when he was raising some money, and they raised very, very little. But the conversation was how much pressure do you want? Like, I can give you more money, but it's going to require more pressure on you to deliver because the expectations are much higher now. And he was like, you can have more, you can have less. It's up to you, but recognize that we're here, and we want to know, like, at what level do you think you can perform? And he was like, he chose, I believe he said he chose the lower option because it made more sense to him. And they raised very little money. They didn't really, the economics of their business made it so they didn't really need to raise that much money. But it's very interesting to think about it like that, and to think about the amount of pressure it adds. And I had another conversation with a client this week. We were talking about if he was going to raise money or not. And we were just played hypothetically, like, okay, well, if you had all this money, what would you actually do with it? Like, where would you deploy it? And we went around looking at different channels and thinking about it. And there really wasn't a channel that was like a home run to be able to deploy right away. And he was like, okay, well, I'm going to wait a little bit because I could throw a lot of money at Facebook, but what am I doing if it's not working currently? If it's not working at a small scale, it's probably not going to work at a large scale. So why dump a lot of money into it?
It's always great to hear that sort of perspective, because I absolutely can understand, right? Like, why somebody would say, I want to go out and I want to raise capital so I don't have to raise money again, or I want to raise money at the highest valuation. Like, of course, you're getting validated for your business. For
sure.
But when I hear entrepreneurs actually kind of bring those other perspectives of it, it's very refreshing.
For sure. And it's challenging. And I think it's especially challenging for first-time entrepreneurs who are navigating a field that is fraught with uncertainty, confusion. There's a lot of opportunities, especially right now, to raise money. And it's not straightforward around, like, this is a proven way to do it, you should do this. It's a lot of like judgment calls, like everything in business, that can have real ramifications later on, especially if the market changes or you go through, a bizarre last year, like like with COVID, where in March, a lot of the companies I was working with were like, we have no idea what's going to happen over the next 3 months. Turned out that it was quite good for most people online, but could have gone the other direction. I'm interested to hear kind of your perspective, being on the CPG investing side. What's the biggest difference between what you guys are doing and investing in tech companies?
Oh gosh, the biggest. So I tend to think most of the tech investors I know, it's the returns, it's the return expectation and the return outcome. Most tech investors I know will expect 10 of their companies to fail 9 of their companies to fail out of 10, right? But they only need one, and they need that one to be a home run. I think it's highly unusual that you're going to have home runs in CPG. I think you're going to have a lot of doubles, a lot of triples, and great outcomes, right? For sure. But the idea of investing in a business on an idea before revenue and expecting it to ultimately go public or get bought for $10 billion plus, right? I mean, a lot of these tech business deals get even bigger than that. That just doesn't happen in CPG. So I think that distribution of outcome is really different. For us, it is unusual for me to underwrite a business getting bought for north of $300 million. I can point to companies in our portfolio that have gone for a higher valuation than that. But when we initially actually look at it, it's more the exception than the rule as far as the distribution of outcomes. Whereas tech, you can have these massive outliers that can end up making a fund versus what we have in CPG.
Sure.
I think the proximity also. I think, if I think about, we're seeing more diversification now, in particular this past year. I think it's really accelerated it. But I think tech investing is still so very, very focused up here in the Bay Area you hear stories about venture capital funds and saying like, okay, well, if you move to within a 25-mile radius of my headquarters, like, yes, we will invest, but you have to be here. I don't go on a plane. Like CPG, it's spread all over the place, right? And that's one of the exciting things that our founders thought of and saw when they were thinking about this unmet need as far as early stage consumer investing, was that there's not a sandhill road. There's not a single place you can go for CPG investing. You have it so geographically diversified across the country. Being able to tap into that and use data to help inform decisions rather than having to fly all over the country in order to do that is a pretty big difference as well.
I will say being in Austin, it does feel like a hub here. I mean, there's a ton of food, a ton of innovation going on here. It's been very interesting. I've been here about 6 years, and that's been one of the things I've noticed is like continual companies coming out. And one of the biggest ones being Siete chips.
Yeah.
I don't know how large what their valuation is now, but I think that they definitely fall on the higher end of the outlier
For sure.
side. Well,
I think Austin, I think San Diego is another bit of a hub there. So for sure there are. But if I think about our portfolio, we have invested in, oh gosh, my numbers are going to be a little bit outdated. But I would say something like 30% of our portfolios in California, 30% of our portfolios in the kind of Northeast. And then the other 40% is all spread out throughout the rest of the country.
Yeah. It's very interesting. It is cool to see. And you're, having successful businesses that are changing the environment that changing the environment that they're in because they're employing people, they are revitalizing areas. It's very cool. When you look at some of the companies that you guys have invested in that have had the massive success, like the outliers, what are some of the commonalities or the things that you generally start to see patterns after a while, especially if you've been in it and you've got a lot of visibility in a lot of different companies? What are some of the patterns that you see for the companies that do have massive success? Anything that you can kind of glean and share with our listeners?
It's interesting. I feel like it ends up actually being focused simplicity. And what I mean by that is I think about like Halo Top, right? Yeah. Halo Top is a phenomenal success story. And it was all about like, let's get the calorie count as low as we can to make the consumer feel comfortable eating that pint of ice cream. Is it the best pint of ice cream you've ever had? Probably not, but they knew exactly what that need was for the consumer that they wanted to address.
Sure.
I think about Supergoop. It's another amazing brand, right? It's that idea of we need to have a product that people can do what you need as far as skin protection from the sun, but doesn't make you feel like you've got a cakey substance on, right? And it's in hindsight, it's obvious, right? In hindsight, it's like, yes, that is easy. Liquid IV, the ease and the hydration, like all of these brands, it's that simplicity, but it's also that focus on their one thing that they do really well and that one unmet need for the consumer that they're meeting.
Yeah. Yeah. Halo Top, it's a great example. It's like, we'll just make it so you can eat. People are eating a whole pint of ice cream. Let's make it so it's less taxing.
Make sure you feel better about it at the end of the day.
That's really interesting. I like what you said earlier about some of the things that one of the fields that is growing is like better for you or cleaner ethnic food. I feel like that's very much aligned with what you're saying about simple, like focused simplicity, in the sense that there are foods that people want to eat that may not make them feel good. And if you focus on that and maintain simplicity and focus on that, that can be a massive market that can grow and be very successful. Right now, I mean, over the last eight years and during this time of growth with CPG and all these different companies, what also has been growing has been Amazon. How do you think about kind of retail, Amazon, direct to consumer, how they play together? And I know one of the things you mentioned earlier was that two of the companies I had mentioned was Native and Dollar Shave Club had reached a certain level of scale before they were acquired. When do you like to invest in companies, and what is the playbook, if you have one, for how people should think about retail, Amazon, and direct to consumer as they're trying to grow their startup?
Yeah, so I'll take the question just about Amazon and how we think about it first. I I think if you'd asked me that 2 years ago, or maybe even 3 years ago, I would have said, you know what, strategics don't value Amazon sales as much as they value retail sales, right? Sales through the bricks and mortar, sales through the Walmarts, the Targets, the Krogers of the world. I think this past year that has completely changed. I think the idea of there being several large most founders that I speak to hate this opinion. So I'm going to throw that out there, but I actually don't believe every business has to have a direct to consumer business. I think most businesses should be retail and Amazon, or retail and marketplaces. And we'll put Walmart.com, Target.com, Amazon.com, Thrive Market, like all of those players in there. But do I really want 16 boxes showing up on my doorstep every week? Do I want to manage subscriptions or manage through direct to consumer ordering for all of those products all the time when I can just aggregate it all in Amazon? That's my personal preference. And yes, direct to consumer for your super loyal customers, for testing new products, for trying new flavor profiles, great. But the idea of I'm going to have a $30 million business and 10 million is going to be from D2C, 10 million from retail, and 10 million from Amazon, I personally don't believe many brands need that sort of direct to consumer business. So I think Amazon is becoming increasingly important. I think we have started to see that aggregation, the benefits of the marketplace. I think this past year you can see that through Amazon's numbers that they report publicly, right? I mean, we've seen that really accelerate. Yeah, it really accelerate this past year. I don't see how that changes anytime in the near term. And I think most strategics are actually now looking at this as like, okay, this is a channel I really need to learn about. I need to understand better. And let's find other companies that have been successful in it. Rather than previously, I think they discounted the value of those revenues. I don't think that's the case anymore. As far as in the life cycle, I don't know that there's necessarily a hard and fast rule that you have to do retail versus you have to do Amazon versus direct to consumer in any which order. We've seen a lot of really successful businesses launch in Amazon and subsequently move to retail. We've seen a lot of really successful businesses launch in retail and subsequently grow in Amazon. I don't think we necessarily have a playbook. I will say Amazon, if you have functionality or you have a particular diet or nutritional benefit, it is easier to meet that on Amazon. And so what I mean is I can search for low sugar keto bar. That's an oxymoron. I can search for peanut butter flavored low sugar keto bar, right? And it'll be a very streamlined. I'll get 6 options or 8 options or whatever it is on that front page. And I will be able to search and click and it'll go in my basket. That's much more challenging to do at retail, right? So your ability to actually use keywords, your ability to actually, if you've got functionality that the consumer is looking for, Amazon's a really great outlet for that. Retail is still, at the end of the day, where the bulk of the volume is done. That's shifting, but still, it's got to be 85% of groceries are still bought through the retail channel. So being able to work in both options, I think, is particularly compelling.
That's really interesting what you're saying about the transition from direct to consumer, the value of direct to consumer, to value of Amazon. Because I feel that as well. Like I see that as well. The challenge that I look at with Amazon, or the thing that makes me uncomfortable, is like the quality side of Amazon. I feel like quality on Amazon has been degrading rapidly, and the ability to like find a high quality product is becoming more and more challenging. And the ability to protect your brand on Amazon has gone up and down, and it's kind of like inconsistent a little bit. At least, and I think in food, it might be a little bit different. I think outside of food, it's really interesting. If you're going to find some sort of, like I looked at Amazon to buy some sort of generic thing that I know doesn't really matter, the brand, or some sort of, like where it starts to get messy for me. And it's interesting is like when I'm searching for something with functionality, trust and building trust for a product on Amazon is very interesting and challenging to do, because you might have 6 different products with reviews that are positive and not know which one actually is the high quality version. And it's interesting seeing founders protect their brand with a direct to consumer side And that has been kind of the playbook, at least for a while, like use the direct to consumer side to be able to like maintain quality levels and then compete on Amazon. What do you think the future of Amazon is going to look like with regards to protecting brand and protecting like the integrity of the products on there, as more and more products are listed from different countries, from different vendors who may not have the same like high level integrity that other competitors do have?
It's a great question, and it's a huge challenge. I think maybe a little bit less so in the food space, because I do think Amazon has a level of compliance in food and beverage of kind of eliminating like counterfeit type products, right? So
it's more dangerous.
Yeah. So I think they do have a level of compliance there, but no doubt there can be counterfeit products that are launched that can end up being problematic for the brand. I think this is what most brands really wish for, right? I think about Liquid IV, and I personally haven't seen the statistic, but enough people have quoted me this that I have reason to believe it's true. That 80% of hydration sticks on Amazon are searched for under the name Liquid IV. So like people aren't looking for hydration sticks. They're not looking for powdered hydration. They're looking for Liquid IV. So being able to actually have that brand presence, and be able to engage with the consumer, whether that be through social, whether that be through influencers, whether that be on the shelf, so that they're actually looking for your brand and not just a peanut butter keto bar, I think is kind of the holy grail as far as how you can avoid that noise of other products and other qualities within Amazon. But for sure, it is a complicated distribution channel. It is getting, honestly, talking to a lot of the founders that we work with, they're becoming less forthcoming with information, not more, as they get bigger and get more and more scale.
Sure.
And so it's becoming more and more of a challenge to work with, but it's at this point, I think, a necessary evil that it's like saying 30 years ago, you know what, I'm not going to work with Walmart because they're going to push my prices down. Like, how did that go for brands?
For sure.
Not so well.
No, it's very interesting. It's we're so far down the path of Amazon, and it was accelerated even more in this last year, where grandparents who had never been on Amazon.com before are now Prime members, and they're consistently ordering groceries or ordering products from it. And that happened really quick. We're not going back. So it's interesting moving that into the playbook and how to approach it and how to deal with some of the challenges as a seller that you face on Amazon. But I love your example. It's like the Kleenex example, in like modern day Kleenex example, where on Amazon, people are searching for Kleenexes when they're really thinking about tissues. People are searching for Liquid IV when they're really searching for powdered hydration. And if you can own that term, that allows you to be able to compete at a different level than the competition. And I guess that is actually a vision that you can have for your, like, a strategy on Amazon, which is using some of the outside direct to consumer marketing to brand in a way that when people go to Amazon, they're searching for your product. Not
easier said than done, for sure.
Easier said than done, for sure. And it requires a lot of advertising spend. And anytime you launch a new product, it's very challenging. I mean, the returns you get when you're trying to educate a market are very low compared to the returns you get when you're trying to capture demand from something that's already been marketed for 50 years. But it is an interesting way to think about the success on Amazon. It's interesting to hear that more strategics are looking for sales on Amazon and value them the same, because I think initially, like you said, from a couple of years ago, it was not like that. I got just a couple more questions here that I'm interested in asking you. You've worked with a lot of entrepreneurs that you guys have. At what level of revenue, or may not even be revenue, because revenue, I feel like, depending on the company, they can be at a different level. And revenue is not really the deciding factor. But at what level do you see the most challenges for your entrepreneurs? Like, as they progress and they go from you guys raising capital with you to strategic exit at some point? Yeah.
I think it often is, and this is not always the case. But I
Sure.
think there often is a different entrepreneur that takes a business from 0 to 10 versus 10 to 50. And you could maybe say 0 to 20, 20 to 50, there's a bunch of different things, but there gets to a point when it's no longer about the branding, and it's no longer about like creating this really amazing product that I have the ability to finding this unmet need. It's about operations, and it's about scaling, and it's about efficiencies. And I think you don't necessarily need the founder to leave the organization at that point. I actually think very often I've been so impressed by some of the founders that we've worked with who have recognized, you know what, I don't have the skill set to get this from 15 to 50, but I do have the skill set to continue to work on product development. And sure. I know my customer and I know what they're looking for. So I'm going to hire somebody else who can now be the CEO, and I am the president or CEO, and I'm now chief creative or whatever the terminology is. But I know what I'm really passionate about. I think that's also the big difference, right? It's like, this is what I want to be doing and what I've proven that I'm really great at, versus the CEO who can help more on the operation side, more on the scaling side. And again, I don't know if that's 10, 15, 20. I can point to founders
For
who
sure. The revenue, I agree, it doesn't matter.
Right. But it's that, that recognition of like what, and I think honestly, it often comes from like, what energizes you as a founder, right? Is it the operations? Because by the way, I've got some founders who are like, they are in the weeds of the raw materials and negotiating those prices, and they love it. There are also some founders who are like such visionaries that like, I am all about finding like new product development and identifying the needs of the consumer. It's what energizes you, I think, is often the answer to that question as far as where is the time to bring someone else on.
Cool. I like that. It's a very interesting answer. I have friends that have started CPG companies and have taken that path where they got to a certain point and they're like, you know what, it's no longer I'm not the person right now to take it to the next level. But I am the person to create those products. Last question here. If you were trying to start a CPG company right now, and you mentioned some ideas at the beginning, but what would you be looking at, or what like markets or ideas or things that you're really excited about right now from an investment standpoint that you're like actively being like, this is kind of a hot area? I know you've got Helio, which helps identify what you were talking about earlier, helps identify the areas that are growing rapidly. What are some of the areas and that you're really excited about and you'd be looking to invest in or start something in if you were an entrepreneur?
Well, I have to say, I love the entrepreneurial journey. I admire entrepreneurs so very, very much, and the risks that they're able to take. I think my personal ability to do that is less so. And so I'm going to lean more on what gets us excited as investors, versus the business that I'm going to launch. I think we're seeing a huge surge in ready-to-drink cocktails, and I think that is in really early innings. We've seen a ridiculous amount on the seltzer side, but like real premium ready-to-drink cocktails, I think is a real opportunity. I think within the beauty skincare space, the idea of clean hair care and really like the skinification of your hair, I think is a trend that we're seeing grow very quickly. Beauty focused on particular demographics, we're seeing grow, and that being skincare, that being cosmetics, is a big trend that we have been seeing grow really quickly. I want to say men's beauty. I feel like we should always be cuspy with men's beauty, but I just don't feel like we're quite there yet. But ask me 5 years from now, I probably will have a different answer. Within food, I think, like I was saying, like keto, amazingly enough, continues to still have legs and continues to still grow really quickly. And even if it's not keto, the idea of low sugar, high protein, I think that is a trend that is there to stay.
I think with keto, nothing has changed, right? Like obesity is a massive challenge in our country, and it's around the world. And it's like the same fundamentals are there, right? That's why it's so interesting to watch it continue to thrive and grow, because not much has changed. And I like whatever is going to replace that is going to be solving the same challenge, at least in my opinion.
And look, keto, it was Atkins.
Yes,
right? Like,
exactly.
it's a different
It just
name,
continues to
tweaked,
shift.
but like it's the one other trend that I would highlight is just kind of self-wellness.
Yeah.
And I put anxiety, I put sleep, I put meditation, I put, I think this past year has really been rough on all of us. Anything people can do, whether it be through apps, whether it be through ingestibles, to help improve your mental well-being, I think is going to continue to be a really big trend.
Those are all really interesting and great examples. What are your thoughts on like psychedelic products as we're moving in toward? I've noticed that as certain states have legalized medical use of mushrooms, there have been products that have been rolling out. Is that something you guys are interested in? Are you looking at that at all? Is it something outside of your investment portfolio? Where do you see that going?
So it currently is outside of our purview. We can't invest in anything in that category right now. So it hasn't been an area that I've focused intently on. We have been seeing a lot of brands that have been growing. I think until you get, and it's like this with any kind of new product, right? Until you get some sort of national federal regulation around it, it's really challenging to make a very big business. And I don't think we're there yet. But it's certainly a category to watch.
For sure. It's very interesting to see lots of changes. Karen, this has been so fun and interesting. It's been different than a lot of the other conversations that I've had, and I really appreciate your point of view. Thank you so much for being on here. If somebody's interested in learning more about what you guys are doing, what's the best place to either learn more about it or connect with you?
Yeah, you can email me directly at khowland, HOWLAND, @circleup.com. Or you can find me on LinkedIn and would love to connect.
Awesome. Karen, thank you so much.
Awesome. Thank you. It was a pleasure.